April the 21st, Michael Vaughan with Brian Acker. And Brian, your last, the quarterly newsletter you titled The Big Chill, and I guess because we did have a bit of one to begin the year. Is the big chill behind us?
I think so. We're in the first quarter's earnings season, so that's, we got Netflix tonight, we've got a few biggies this week, so we'll be looking at those. Yeah, we hit new highs, obviously in probably early March. We've had a nice pullback. We never went to negative numbers.
Yep.
And now we're on the upswing again, so which is pretty good.
Well, the American market did stall out for a bit there in February, but the Canadian market did not.
The Canadian market is looking really attractive, especially the energy sector.
You haven't said that for ages.
A long time, and you know, we've owned CNQ, or Canadian Natural Resources.
Mm-hmm.
We own Suncor for, it seems like forever, but they're starting to go up in price. Certainly clients have an individual holding in Husky because we like the dividend. Even that's moving well. So yeah, I mean, energy is moving. That's a big sector if in the Canadian market, and a sector that we're overweight in. So when you look at Canada's performance, I think we're pretty close to 6%, and when you look at the U.S. performance, we're close to 7%. So you know, both markets are looking quite good, and we do have I should say a big slug, and we are overweight energy in the U.S. as well. So their stocks are acting very well as well. So.
You and Warren Buffett, it seems.
Warren took a big position in Exxon. That's the second time he's been there. He was there 20 years ago. And again, I have a blog that says this is the third time, literally in 18, 20 years, that Exxon has been at this low valuation.
You see, that's the surprising part. I mean, you wouldn't think that the valuations are low. I mean, the number seems high.
Yeah, but when you look at relative to his balance sheet, it's incredibly cheap, and plus it almost pays a 3% yield. And Exxon is by far the best run company in America, as far as I'm concerned. So yeah, but that was back at $88. It's now trading over $100. Right. So, but energy is leading the way in terms of rates of return, and maybe that's a big surprise from here to the fall, right? So,
the street bailed on energy and stayed out for ages.
Long time, dirty oil,
yeah,
etc. Yeah, we've heard that energy service companies, drillers. I mean, they went in almost depression-like prices. Like we took a position in old precision drilling way back, and we're up 45% on that position in our Canada focus. So, but yeah, as I said in my comments, they're getting jiggy. So there's a lot of action going on, and the U.S. guys who bailed out of the industry maybe 2 years ago, they're coming back in droves. Certainly in the last month or two. So.
Is there still money on the sidelines? I mean, there must be. People have to give, you know, with the rates of return on fixed these days.
I mean, I think there's a whole category, maybe a generation of people who've sworn off equities for life.
Yeah.
But what I like about this market more so, as time goes by, you know, we're now 5 years after the crash or the bottom of March 9th, 2009, is the rotation of the market. Money is no longer leaving the market once it's made its money. It's now rotating, trying to find value. And we haven't had that for a long time. And our system, our numbers, our quant system is set up so we constantly look for cheap valuation stocks. And finally, this market is returning to that environment where the money is looking for cheap valuation stocks, as opposed to making its money going out of the market and re-entering the market when they find something cheap. So.
Why does the bubble word come up so often in the mass media?
Well, I highlight even today. There's a guy, Henry Blodgett, says, you know, stocks are our 2000 valuation, like the top of the market, and nothing could be further from the truth. So again, I try to tell clients through our blogs that we're not even close to being at high valuations. We have a long ways to go. And
when you look at the balance sheet.
when you look at the balance sheet and grazers, I call them grazers of financial information, if you're going to rely on that information to make long-term investment decisions, well, you're stuck at 1% or 1.5% in fixed income, and God bless you if you can make your financial returns or your retirement based on those rates of return. So.
Always great to see you. I'll be in the merry month of May. Thanks, Brian.
Good to see you again, Mike.